It's not always easy to figure out exactly how someone else interprets trading knowledge and whether they truly understand the implications of it. Now, sometimes it takes a chance conversation in order to pick apart just how differently your own interpretation may be. So this week I was lucky enough to have such a conversation and a huge trading mistake became apparent. Now the way risk is handled by Van Tharp, as I'm sure many of you already know, is by expectancy. Expectancy is basically your average trade in terms of your initial risk. So if your initial risk on a trade is $500 and the trade goes on to make $1,000, the trade is said to have had a 2R profit. If initial risk is $300 and you lose $450, you've lost 1.5R. Now, the way I see it is it's a very good way to compare the quality of trades where the specific dollar amounts don't always align particularly well, and it gives you a better idea of what you should expect to make or lose on each trade that you take. In my opinion, this analysis is particularly well suited to people trading across a broader range of products such as a portfolio of stocks. And this is how the chance conversation began. So my friend and I were talking about his stock trading, and he was eager for me to take a look at his portfolio so he could just show me what he'd been doing. As he ran through his different open positions, there were about 50 of them, I struggled to get an idea of how good each trade really was, and that's when I asked him about whether he uses expectancy. Now, he said he didn't know about expectancy, and he asked me to explain it. So after a basic explanation, I set about and pulling in his trade data to do a quick demonstration of expectancy for him. But as I started to break things down, something concerned me. So what's your initial risk for this trade? I asked. Well, I don't really have one, he said. Well, where would you be wrong? I said. So the conversation continued in this manner for quite a while, with me trying to get to the bottom of what he thought of as risk. So if you don't have a stop, you just let this stock go to zero, I said. Well, yeah, but it's a great stock, he said. So not only did he not define his risk, but what eventually became apparent was that he felt that only going after trades with at least a 2-to-1 R to R adequately covered it. What R&R does do in combination with win rate is to find whether or not an opportunity is worth taking or not. It doesn't tell you the value of your initial risk in isolation. It tells you the ratio of what you make when a trade works to what you lose when a trade doesn't work. But it might be enough to figure out what your initial risk is so long as you identify the other side of the equation, what your profit target is going to be. To quote a very famous and successful trader, losers average losers. That's from Paul Tudor Jones. This wisdom seems pretty obvious on the face of it, but let's think of it in terms of my friend and his stock portfolio trades. There are two types of entry risk that you can take. One's information risk, the other is price risk. Many people struggle to find the right balance, even if they understand the principles at work. But there are also two types of trade risk people take. One is account equity risk, and the other is market behavior risk. Account equity risk is risk relative to the capital in your account. And it's all about staying in the game long enough to make your trading edge pay. Market behavior risk is the risk that a market will change behavior and the probability of price moving significantly against your position. Both must be accounted for. However, like my friend, most people tend to only focus on account equity risk. So it turns out that my friend improves the average price of his trades as the market moves against him. He basically taking longer term views and trading around his position, not simply adding all the way down. So account equity risk is clearly something he's trying to factor in. In fact, I see nothing wrong with a skilled trader doing this, unless they do not take into account that there's a point when the market changes in behavior and demonstrates that the trade is wrong. This is market behavior risk. In reality, it's best defined by a combination of a threshold technical price level and a shift in behavior on a breach of this price. My friend accounted for neither. The true wisdom in what Jones was saying is this. When a trade's a loser, not just offside, you shouldn't still be looking to take positions in the same direction. Many traders look at a market in a way that is totally skewed toward their own interaction with it rather than based on a market's own action. More precisely, some traders trade in dollars and not in market price. True, the markets are a sum of the participants' behavior. However, it's highly unlikely that a market is going to flip its current behavior just because Joe Bloggs hit a 10-tick stop. But it might just change if it breaks a key technical price level, for example. And it's at this point that it's probably not wise to hold or add to your original position. Excellence in trading comes in part from understanding that it's critical to marry the ideas of risk and create a strategy that encompasses both account equity risk and market behavior risk. If you don't make it your business to do this, you'll also make this huge trading mistake.